1, 3.
Did you ever want it? Did you want it bad? Oh my, it tears me apart. Did you ever fight it? All of the pain, so much power running through my veins, bleeding, I'm bleeding, my cold little heart. Oh, I can't stand myself, and I know in my heart, in this cold heart, I can live or I can die. I believe if I just try. You believe in you and I. In my heart, in this cold heart, I can live or I can die. I believe if I just try. You believe in you and I. You and I. In you and I.
All right, thanks. That was from the band Vicota on YouTube. Check them out. And welcome back. Thanks for watching. This is the Short Vol Show Live. My name's Dave, and I'm streaming to you live from Cape Cod, Massachusetts. And kind of an eventful end to the week. I made the mistake of kind of sort of celebrating in my head, having made some money on the down move Thursday, and then pretty much right after the close on Thursday, things started to go south as we started to get reports from the strikes in Iran. And Friday we came in, stuff was down, but it kind of rallied back a little bit. The VIX term structure kind of held its shape, but we've heard a lot of people talking, here comes the recession. This is just the start of a big down move. A lot of negativity out there, and I have to tell everybody just to calm down. Everybody calm down. And also I've gotten a lot of requests, emails, whatnot from you folks. Thanks so much for reaching out to me. I always like to talk to people, but just to let you know, it is hard sometimes to keep up with the volume of stuff. So if I haven't got to you, hang tight and I will get to you as soon as possible. I want to answer some of your questions out there, take a look at the position. Let's talk about the market moving forward and more as we march onward. Thank you for putting up with me. I was going to come on, I know, a couple days ago, and that sort of got canceled. But here we are now. We have had a move up in the VIX over the last couple of days, but VIX still pretty tame. Closed around 14 on Friday, and that's lower than the average, of course. So things could move higher than from here. We have had some action in the indices. We had the down move. We had the big up move and the down move. If you look at the E-minis here, and we go to like not a daily chart, maybe like a 5-day chart, something like that, you're going to see that stuff is starting to move around a little bit more. So that could be a sign that things are going to start bouncing around more. However, let's just remember that we don't know what's going to happen. And all these people calling for the end of the world and all this stuff need to just settle down. You know, as a trader, you need to become comfortable with the fact that you don't know what's going to happen. And people react to that differently. Some people just have to have an opinion all the time and take an opinion. It's okay not to always have an opinion. You can just not know what's going to happen, be comfortable with not knowing what's going to happen, and just kind of look, where's your risk, and try to manage your risk as best you can. Yeah, it's brutal out there in social media land. You know, when you put yourself out there, people attack you, and sometimes it seemingly has nothing to do with me. It's just they're like having a bad day or something, and they jump on you. And, you know, that's just the way it kind of is sometimes. But, yeah, we have had a little up move here in the VIX, down move in the markets. Is this the beginning of a big recession? I don't know. You can't tell what something is until a while after it. However, you know, a recession generally means 2 quarters of down activity. And we haven't even had a week of down activity. So it seems a little too early to call that this is some big move. However, we have seen some, you know, volatility with one big up day and one big down day. And that's different than we had before. Look back over the last 2 weeks. And I'm actually going to... let me see if I can back this out even further here. And let's go to a different chart. Let's look at UVXY here. And you see UVXY, you know, we had a little while here, several days where like nothing's really going on, right? And then you see, boom, boom, some moves. Now, this whole time, though, we are in heavy contango. So the stuff is decaying the whole time. We're staying in contango this whole time. We haven't switched to backwardation. And even now, when we pull up the term structure, we can see we are in, it's just a comfortable shape. Now, let's not I see a lot of people making big light of this October, November stuff. Let's not worry about that too much. In fact, I kind of wish it wasn't even on the chart because it's not pertinent to us right now. It's such a small thing that it shouldn't be distracting your focus from what's going on here. And what's going on here is still a very healthy term structure. Now, yes, contango 2 days ago before these up and down moves was 14%, but now it is still 10%. We did get down to like 8-9% in the heat of the action during the day on Friday, but still a term structure which says that we are in the middle of a slow rally until further notice, and until that changes, that's where we are. We're in a rally. Look at Tesla, for example. Tesla stock. And a lot of stocks actually, huge, just big continuation of the up moves over Friday for Thursday. And you see, look at these Tesla moves. Does that look like an economy that's in recession? Does this chart look to you like an economy that's in recession? Let's look at just the SPX. When you start to listen to people telling you things, it's very useful to just go back yourself up out of daily, hourly charts to a year chart. Look at the year chart right now. Does that look like we are in a recession? It does not look like a recession to me. And people are saying, well, is vol going higher or lower? The average volatility of the market, if you take it over the period since we've been tracking that, is higher. The average VIX the average VIX, we are lower than the average VIX right now in the VIX. So if you're going to make some sort of statistical bet, the best bet would be to say that the VIX would be higher at some point because we are lower than the average right now. But that in itself is not huge evidence that we're getting some sort of major spike. All right, let's talk for a second. I want to answer some questions that people have been posting for me. What's up, guys? Oh, wow, George Soros is on. Hey, what's up, George Soros? Hey, can you loan me $1 billion just really quick? Thanks, that would be awesome. I want to answer some questions. One question I got, which is a good question, which I don't have a good answer for, is with the position we have, what's up, Mateo? How you doing, buddy? Love, check out his content, health, financial blogs, all kinds of stuff. What's going on, guys? All right, I want to answer a couple viewer questions, and for that, I'm going to just flip over here to my my YouTube studio here. And a guy was asking a question about what are my targets for my position, and do I have a profit target? Essentially, like when I'm putting a position on, do I have a target where I'm gonna say if I make this much, I'm going to take the position off. And conversely, if the position goes against me, when am I going to take the position off? And we can use for an example, I have a very simple position to look at. It's not necessarily simple in the strategy and everything, but I have a very simple position to look at to talk about this sort of thing. And here we have it right here, the position I have on VXX right now, which is I'm just long the January 7 and 8 puts, and mostly the 7s. I'm long a few 8s. So I'm long 234 of the Jan 7 puts, and I'm long 10 of the Jan 8 puts that expire in 377 days. And we can make this into a little lesson on Thinkorswim for those of you who are not real into Thinkorswim. So let me move this stuff up so you can see it a little bit better. Okay, so this is a Thinkorswim screen. On the bottom here, you can see the positions. This thing that says position, open, and close. So it's open right now. And so we can see, and I have this set up. You can set this up in different ways by going to settings here. But I have it set up so that it shows, and we'll move my screen over a little bit so you can see it the best. All right, so I have it set up so it shows my delta for the position and then delta for the individual options here, and then it's got trade price, etc., P&L open, and you can see since I put this position on, I've lost $1,000 on it. Now, if we go to an individual option here, we can right-click on it and click View Trades, and this is very interesting because it's going to tell all the trades that we made in this, what the prices were, but most importantly for me, it's going to show the average price. So we essentially bought this 200 and whatever puts paying an average price of 50 cents, 49.77 cents. So our profitability we might base on that. If we sell them for $1, we made 100%. You know, if we sell them for 75 cents, we made 50%, etc. And the question was, where do you get out of this trade? If these puts go down to 25 cents, do you bail out of them? Now, going down 200 puts, going down 25 cents is significant loss. And it's a good question, but I don't have a good answer for it because I don't trade with ideas of how much I'm going to make or lose before I take things off. I'm very much a trader who trades by feel and just by changing conditions, and it kind of depends on the conditions and other factors. Now, when you have an option that's so cheap, like a 50-cent option, a 25-cent option, once it gets down to like 10, 25 cents, if you're short them, people really just don't want to sell them to you because people don't want to sell stuff that's really cheap most of the time. Now, in this case, VXX is fairly liquid, and there's certainly somebody out there who's going to sort of honor these markets. But in general, once options get, if you follow an option that's like $2, let's say we pick an option. Let's go out as far as we can go here. Let's pick an option like these Jan. Everything's so wide. It's hard to tell. But let's look at these, for example, these Jan 10 puts. They're 255 bid at 455. Let's say that this was a normal stock and we stayed 15 or above. Maybe we marched slowly higher. These puts would slowly decay over time until they got down to the area that my puts are at now, 50 cents, 25 cents. But once options get to that low price, they're kind of stubborn and staying around that price. So, for example, the puts that I own here, these 7 puts, if this were to spike tomorrow up to 25, these puts aren't going to go to 0. They're going to go down, certainly, but they're going to be pretty stubborn, because what's going to happen is that if this thing spikes a lot, the market makers are going to crank the volatility, and certainly on these way out of the money options, because if this spikes, market makers are going to know that people are going to come in and try to buy puts, because that's what people do in volatility products when vol spikes. And I don't blame people for that. So people that don't usually trade the VIX, if on Monday the market's down 500 points, will come in, look at these products, and try to buy puts. And a lot of these people aren't paying close attention, and they're just going to pay the offer on some puts because they know that after a spike, these products are going to go down. And so these puts will perform pretty well during a spike, because market makers are going to crank the price, because they know that people aren't going to come in and sell puts way up there. If there's one side of the trade that market makers know people are going to do, it's going to be that they're going to come and buy options. So these 7 puts are going to be pretty resilient because they're so cheap to start with. But to answer the question about what sort of profit targets I have as a trader, I don't think about things that way. The way I think about things is I focus on what I can lose and managing my downside, managing my risk of what I can lose. And what's left over is profitability. So I kind of just see how it goes, and maybe it's just the nature of me as a position trader, or maybe it's just the way I've always done things. But I don't think about profitability. I don't have, this goes hand in hand with the fact that I don't have profitability goals. I just see how things go. I try to manage my risk as best I can, and profitability hopefully will follow somewhere from there. Hope that helped out a little bit. All right, so other questions we've had. Let's take a look at some other questions here. I don't know if you're aware of it. YouTube Studio has changed over the last couple months. Their old format was just that old, and it wasn't very flexible for them. So they've come on with this new format, but people are not very good with change, and so it's taken them a while to roll it out, more because customers weren't willing to accept it than YouTube having problems with the programming or something like that. But yeah, people are looking at any down move as an excuse for a recession, and we got to look at the psychology of why people are doing this. And I think part of it is that people are kicking themselves for not being fully invested during this rally. A lot of people have been on the sidelines for the most recent rally. Also, other people thought we were going to sell off months ago and keep shorting this at every point and really want to be right. And I think the combination of these two things has made there be a lot of vocal voices out there that are bearish, really want this market to go down, and are looking for any sort of evidence they can find that suggests that this market will go lower. And, as long as we have that, and a lot of people talking about this market going down, I don't think the market's going to go down lower. Once again, I don't know what's going to happen. Don't be surprised with anything that happens, but when we look at the charts right now, we're in the middle of a huge rally. We're not in the middle of a recession. So people that are telling you that we're in the middle of a recession, it's not true. A recession once again, by definition, I believe is 2 quarters of down. And we don't have 1 quarter of down now. So there you have it. All right, let's take a look at the chat. Are you exiting before? What is your position now? Okay, so I think we went through this. My position now is I'm long VXX out of the money Jan puts. Edward, thank you. You will exit your apartment. Let me come back up on the screen here. Sorry about that. All right, there I am. Yeah, so I think everybody needs to relax. I would, my ears perk up a little bit when we have 2 big moves like that, because we could be moving into a more volatile period. I see a lot of people. I want to talk for a second about having changed my strategies. Now, you saw me a lot with strategies in UVXY, buying put spreads. I was buying, like, as opposed to buying way out of the money puts in VXX, I was buying UVXY put spreads, and I was buying stuff like an example of something that I would have bought a couple months ago before my strategy changed. And let me straighten my screen out back now. Is something like these, the 20 March cycle, either 20 March cycle or the 21 February cycle in UVXY. I've taken the weeklies off here just for a second to make things a little easier for me to flip through because I haven't been trading them lately. But a couple months ago, I would have been looking at kind of at the money put spreads a couple months out. So, for example, UVXY now 13. I would have looked at a spread that the strikes are around at the money. So I probably would have looked at like a March 15-12 spread where I felt pretty comfortable that in a couple months UVXY would be below 12, and yet it was enough time so that if there's a spike, we could weather it. So the type of spread I was looking at back then would have been like the March 16-12 put spread. And I also was playing with stuff a little bit closer to at the money or to expiration, for example. And I am going to put back my weeklies in here. Although if it takes me too long here, I'm not going to do it because I don't want to waste your time. Anyways, I'll figure that out in a second. But I was picking kind of closer stuff to expiration. However, I can tell you, I feel a lot better now having farther out stuff in time. Now, farther out stuff in time, you have less bang for the buck, and it takes more time to be profitable, possibly. But I have a lot less stress in my life moving stuff out a couple months. So it's something you might want to consider if you're trading UVXY put spreads, is to move stuff out farther out in time a little bit. Now, you're going to get slightly less bang for your buck in a case where if you could have bought 50 put spreads 2 weeks out, now you can only buy 30 put spreads 6 months out. But it's going to reduce your stress levels a lot because now if there's a spike, yeah, money leaves my account, but I know I've got like a very long time for it to come back. And as we know, most spikes only last a couple days. And so what you don't want to happen is you've got 7 days till expiration, and then there's a big spike because then the money flows out of your account and it's basically gone. Yeah, you can close that spread and open another one, but it's not a fun thing to run out of time. And I battled UVXY for 2 or 3 years, trying out different strategies, and a lot of times I had on these put spreads, and a lot of them were not very successful. A lot of times stuff would work out, but then kind of very near the stuff was ready to expire, I would still have a position on, and we would get a big spike, and I would lose real money and have to play the waiting game. And a lot of times I would just give up on the waiting game and I would lose money. So I think you'll notice the more successful traders with these products are people who are A, rolling up strikes a little bit higher. So, for example, instead of betting in February, this thing could definitely go below 10 in February. So there was a time when I would have put on the Feb 1410 put spread in UVXY, where you have a situation where you're buying kind of like the at the money option and you're selling a way out of the money option, and you're making a bet that this is going to continue lower. And certainly with contango levels the way they are, that's a reasonable assumption. But a lot of times stuff doesn't happen reasonably in the end. And if the VIX were to move higher and have a new range of like 16 to 20 or something, there probably wouldn't be enough time, even with 48 days to go, for this spread to come through. So if we were to pick, instead of the 1410 spread, if we were to pick something like the 2016 spread, okay, there's a lot, you're going to make a lot less money if you're successful on the 2016 spread. Okay, it's a $4 spread. It's already only got, almost 90 cents left, 86 cents left in it. It's only got 86 cents left in it. It's a $4 spread. It's already worth $3.14. So you're betting $314 to make 86. That's less money. But in the grand scheme of things, if you buy this put spread and it works out in 48 days, that's still a good percentage return on your money. So my suggestion is that you start to be more conservative in your trade. You roll this stuff up. You take bets that are higher probability that will make you a little less money. And because the people that do that seem to be more successful in here. It's a little bit less risk, a little bit less reward. But if you can book, a win on a few of these in a row and keep that going, it's better than taking these bets that are high risk, high reward. You have a couple that work out, and then you get a spike, and it ruins your profitability. So I would suggest considering at least moving your stuff out in time and moving your stuff up in strikes. That's what's really worked for me. As I've talked before, this put thing that I've been doing in UVXY, buying these junk puts, it worked out really well last month, but 1 month does not a strategy make. And we'll have to see going forward what happens. Now, I'm pretty optimistic with the fact that contango's been so high, 10% and above for a while now, but we don't know if that's going to stay forever. And certainly on the charts, if we look at the historical contango charts, we can see that usually things don't stay like that forever. So if we go to VIX Central here, I had somebody ask me to do a tutorial on VIX Central, and so maybe we'll do something on that. Basically, though, I use VIX Central just to look at the term structure to begin with. And my charts are kind of sideways here. And for the products that we're trading, UVXY, VXX, SVXY, we're basically just concerned with these first 2 months, because all these products are just made up of the futures of the first 2 months. So yes, once we get towards expiration, we start looking at that relationship between month 2 and 3, but it doesn't actually ever appear in the calculation. It has some effect on the indices long term, but don't get distracted once again by stuff far out here. And I almost just click this over to just 9 futures so that you're not looking at the other stuff. So important on this chart is the contango number and the roll yield. This space here, I'm going to make this drawing that I've done before, but I know I have some new people in here. When we're looking at the potential to make money to the downside, what we're looking at is this space right here between the futures and spot. That is the area of potential. And as we go through the expiration cycle, we're moving along this line this way. Every day we're moving along the line. And am I off the screen again? And we're moving towards the right. So halfway through the expiration cycle, which we are about right now, we're actually here on the curve, in the middle of the curve. And so the potential we have to make money is between where the futures are and spot. Every day the futures are slowly falling towards spot, and you can't see it on a stationary graph, but or a stationary two-dimensional screen, but every day they're falling towards spot, and every day as they fall, we're moving up on the curve because we're replacing futures, the front month future, with these farther out month futures. So every day we've got the forces of rebalancing are moving the futures away from spot, whereas forces of, you could call it gravity, but it's basically the relationship between spot and the futures that they have to be together by expiration, pulls them together. So you've got rebalancing moving futures up away from spot, and you've got the fact that these futures are always falling, moving towards spot. And this creates sort of a perpetual cash machine for us if we can stay short these things. The key is to stay short these things and be able to weather the spikes. That's the key. If you're going to be short these things long term, you need to learn how to weather the spikes. If you're going to be short them short term, you need to pick your good entry points to get into these things. And right here is probably not a good entry point if you're not planning on staying in these things long term. Now let's talk about trading to the long side for a second, because there are a lot of people make money trading to the long side, and we don't talk about that very much. The reason we don't talk about that is because there are forces pulling these things down, and we know that UVXY, VXX, they're very bad, inefficient products to buy volatility. A better way to buy volatility, if you think the market is going to go lower, a better thing to do might be to buy puts in a stock that's a proxy for the market. So, for example, maybe Apple. Or maybe Amazon might be a better spot if you're looking to bet the market's going to go down than buying UVXY. Certainly, if there's a spike and you own UVXY, it's going to pop. But I usually tell people don't stay long UVXY longer than 48 hours at a time. All right, let's see. The chat doesn't seem to be moving. Do you guys see the chat moving? Let me see if I can. I guess it's working. All right, so there you have it. Go ahead, Edward. You don't have to have a question. I was just making sure that stuff was out there working still. If you buy a long put, would it profit quicker than a put spread? It really depends on which, I know this is kind of a cop-out answer, but it really depends on which put it is and how big of a down move we get. Certainly, when we're looking at puts, if you pick a put that's way in the money, it's going to be really just a proxy for being short the instrument. So, for example, in UVXY, if you were looking for a quick down move, like let's say, for example, we were in a situation like Friday when we had a spike. And for this, we could pull up the chart for UVXY really quick. Let's say you're in a situation like Friday and there's a spike and you want to, you're like, wow, this spike is, everybody says this is the end of the world, but I know spikes only last typically less than 24 hours. So what I'm going to do is I'm going to take advantage of this, and I want to take a little ride on the UVXY train. So what can I do that's a efficient way to take a little down ride on the UVXY train? Well, one of the best ways you could do that is pick pretty close to near week puts. Why do I say near week puts? Because it's the most bang for the buck, and there's a decent amount of liquidity. If we look at UVXY options, now these are 2 weeks till expiration, so these aren't front week, but 2 weeks to expiration puts. You can see there's a decent amount of liquidity here. I've got the chart set to volume and open interest on my TD Ameritrade charts here on the layout. And that's going to show us, look, every strike has got at least some trade on it. So we get a spike, you want to take a little ride. A great way to do that without having to deal with shorting the stock, worrying about getting bought in, this or that, is to buy some puts that are kind of deep puts. So at the money is 13.5, 14. And these markets are wider than they would be during market hours, obviously. 140 bid at 425 is not a good market at all. But when the market is open, these are going to be like 10, 20 cents wide, and you can get filled mid-market. So we get a spike, I would look to buy something like the 14.5 puts, and I would put a bid in mid-market because somebody's going to fill you pretty close to mid-market here. Now, this stuff does decay, so this would be a trade where you're looking to make some money quick. A spike comes in, you want to jump on some stuff. Okay, yeah, I'll get to the rest of your comments in a second, Edward. But just talking about the situation where, like, we're in the middle of the day, we've gotten a spike, you happen to have some money on the side in your account, and you want to play to the short side. Buying some either at the money or slightly out of the money puts close to expiration is a quick and easy way to jump in, and pretty efficient as well. Now, this stuff, you don't want to hold on to it for days and days because it is going to decay. To tell how much decay is in an option, you can either just do the math and add the premium to the strike price and subtract the underlying price, or you could just look over to the call markets, and that's going to tell you how much is in a put. So when we're looking at these 16 puts here, the market's very wide, but when the market's open and they're tight, you can tell that there's about 50 cents in premium in these just by looking over at the call on the other side. As far as other puts farther out, I am not a huge fan of buying puts outright because they can sit there and rot, and especially if we spike from here. We have to always entertain the fact that the worst thing that can happen is probably going to happen to you and to me. Now, there's some guys out there who, they're going to put every trade on and they're all going to be winners. But for somebody like you or me, as soon as we put a trade on, it's going to go against us, and we're going to have to manage our position. So my suggestion is put spreads are a much better deal as far as theta because you're buying one option and you're selling another option against it. So as you move out in month, there's higher and higher premiums. It's harder to decipher, but you're buying one option, you're selling one against it, and so you're not having to deal with that theta decay as much. The way I've sidestepped the whole theta thing with my current position is just buying these dirt cheap options that if you buy an option for 25 cents that's got a year to go, then just doing the math tells you that's less than a penny a day that would have to come out of it. So, and even buying options that are more than 90 days out in UVXY, buying straight out puts, well, first of all, if you buy ones that are way out of the money, you're not going to get that much leverage from them or bang for the buck. So if we look to UVXY and we look to like June puts, buying way out of the money puts, it's going to cost you a lot of money to not control very many deltas. And if you do pick at the money puts, well, then you've got to deal with that decay, and it's still going to be some decay. Let's take a look at it, for example. And this is the market gods. Yes, the market gods are real. This is what you guys should be going through when you're thinking about trades. You should be going into, I don't know if you have Thinkorswim, but if you don't, Thinkorswim is free. But you guys should be going in here And when we're talking about maybe buying a June at the money put in UVXY, that's 167 days to go. You should be clicking on the option and right-click and go to the Analyze tab and check it out. So let's see. If I were to buy now, the price, this is showing the offer price, but let's pick a reasonable mid-market price. And I don't know if this is reasonable, but just for this example, let's use $3 for this option, okay? So we know each one of these puts we buy is going to cost us $300, and that's going to give us 35 deltas. So essentially, it's going to cost us $1,000 for each proxy 100 shares we're short of UVXY. So we're going to pay $1,000, and that's going to decay over time. Now, so let's say we had $5,000. So we were going to buy, so we could buy 15 puts. So let's put in 15 puts just for the sake of argument here. Okay, so 15 puts now is costing us $14 a day. So, so what I'm doing here is I'm going in and I'm checking out different trades. And this is what you guys should be doing when you get an idea for a trade. Go check it out. Go, all right. And this is pretty powerful because we can go in here and if you don't, if math isn't your super forte, you can actually go in here and create a duplicate order, bring up the trade. In the trade ticket here, if you hit confirm and send the first time, it's not going to actually execute a trade, but it's going to give you this information. Okay, what's the buying power effect? What's the maximum loss? What's the maximum profit? And you may be confident of your abilities to do this stuff without pulling this up, but it certainly makes you feel a little better to see it actually on the screen to confirm that the math you were doing is the same as the math that Thinkorswim is doing. This is a definite confidence builder. The other thing you can do is you can switch the months up. You can say, okay, well, what if these were to be the March ones? Well, how would that change things? How would the price change things? And one of the most powerful things that I like to do, especially when thinking about something like buying a put, let's go back to June, is, okay, we know that these are only decaying by $14 a day right now, but we know that decay does not happen in a linear function. We know as we get closer to expiration, this number is going to start getting higher and higher and higher. And so what I really like to do is go over and change the date here. And you can just click through and move the date forward and see, okay, well, Monday, these would cost me $14. Owning, if I spent $5,000, I would have control of 500 short deltas in UVXY. And I know that on Monday, they're going to cost me $14 a day, these options. However, let's cruise through and see how much that's going to cost me in a month. And you could just click every day on here, or you could bring up the calendar, switch it a month ahead. So by February 7th, these cost 16 a day. So they've only gone up by $1. So you could hold these for a month and it would only be costing you $15 a day. Now the other thing that of course you can do with this is you can tell how much will I make or move if UVXY moves X amount. So for example, you could say, all right, well, this trade, I know $5,000 is going to get me short 500 deltas. So if UVXY goes down 10%, this is showing I'm going to make $900. If it goes up 10%, this is showing I'm going to lose $500. And this information is very useful. Now, I would be careful a little bit because notice how here, when we put in the price of $3, that's showing us immediately making $158 because $3 is different than the price stuff got marked at. Whatever the price got marked at on the close is what is going to be the most accurate for this P&L stuff. So if we put in $3, it obviously got marked lower than that on the close. So you want to subtract this 159 from any of your calculations, or you want to change the price that you're modeling to the price that these options got marked at, which I'm sorry, what I meant to say is got marked higher than $3. So got marked somewhere around $3.12 or something like that, just by trial and error here. Obviously, we could look it up, but be aware of the way what price you're putting in here is affecting this stuff. But you want to go through and check out different stuff and see how it works. Okay, so what's the difference between buying this 13 put or buying a put spread? So for $5,000, we could have 500 deltas costing us 15 a day by buying these 13 puts. Well, let's try to find a put spread that is similar in deltas to this and see where it gets us. So let's go to June. And why am I doing June? I'm sorry. This June. And instead of picking the 13 puts, let's pick a put spread that's around, kind of around that area. So maybe the 16-12 put spread. Buy the 16 put, sell the 12 put. So, all right, so here's a put spread. There's $4 between the strikes, and we're paying a little over half for that put spread. So $200 each. So let's see. So let's try 25 put spreads. So if we put 25 put spreads in, and we analyze, and we're back to analyzing the trade here. Let's make sure nothing else is clicked. So that would cost about the same amount of money. It's going to give us, instead of 500 deltas, it only gives us 400 deltas. However, look at the theta. Theta is much smaller. Now, remember, theta is going to change depending on where the stock or the underlying price is, right? So if this put spread were to work out really well and we move down to $9 next week, which we're not going to do, but just for sake of argument, then this would show us collecting more money. However, if we spike, it's going to show this theta costing more. So this theta is dynamic depending on the price. However, instead of 14 a day, you're paying almost nothing. So you're sacrificing a little delta, but you've got less theta working against you, which I really like. There's other trades you can put on that are a little bit more complicated to put theta in your favor as well, such as buying a put and selling a closer month put against it, or buying a put and changing strike. So, for example, the other thing you could do is you could buy those 15 June 13 puts, and you could sell a lower strike against them. So you buy the June 13 puts, you sell the Feb 12 puts against them. And this way you've got, you've sold something against it, so you can actually be short and collecting money. So there's all kind of interesting things we can do with options that I would urge you to check out. And you can just go in here, set up the trades, and see what they look like. Now, if I go to the side over here, I just want to show you one other little trick here. If we go to the side here and it says vertical, you can switch that to custom, and then that will allow you to change any of these things, whether it be how many you're buying and how many you're selling, because it could be a ratio. You could buy 10 and sell 10 of one month and sell 15 of another. It'll allow you to change the months and all these different things. So that's a little tidbit to check stuff out. But I would experiment and look at different stuff and see what interests you, because options are an amazingly powerful and precise thing that allow you to put on such a variety of different trades. It's definitely an amazing world out there if you haven't checked out different options recently. Let's see. What do you think about buying those cheap, far out of the money that you had, but after a major spike, like at the end of last year? I would think that that's definitely an option. Get it? Option. But you want to make sure that you're following this stuff ahead of a spike so that you're confident in the prices that you're buying, because as I said, during a spike they're going to crank this stuff up. So the last thing you want is, if you weren't paying attention, it would, if we go to those VXX puts, the ones that I own right now, if you weren't paying attention and there's a big spike during a big spike and they widen this stuff out, you might think it was perfectly reasonable to actually pay the same amount I paid, 50 cents. You know, this thing could spike to 25 and they could crank volatility so much that you would be like, oh, 50 cents, I guess that's okay. And you might end up paying as much as I paid with VXX a lot higher. So you want to know your markets and you want to know what is a reasonable price before a spike. But that would be a good idea during a spike. I would suggest that there might be something a little bit better for the buck, though, during a spike. So, for example, you know, I paid 50 cents for these 7 puts with VXX down here. You might, you know, it's certainly likely that you could pay 50 cents for the 9 puts during a spike. But I would go by the same, if you're going by the same principle of buying junk, during a spike, I would look out there and see, okay, well, what put is offered less than, you know, really cheap during a spike. Certainly, just during that spike we had right now, you could have bought these 7 puts for 43 cents just a day or two ago and made a huge profit. Edward, true or false? VIX spike, all puts go on sale. That is true. All puts go, you know, puts go down when the underlying goes higher. However, when they crank volatility, they don't go down as much as maybe they quote unquote should have. So certainly true that during a spike, all puts go on sale. But you do want just, you know, the caveat with that is you just want to be paying attention so that you don't get ripped off. And one way to just help guide you with that is just to look at the implied volatility. So if you know that if you look at the month and you see this month now where it says, let me get out of the way here. If you've been looking on the screen and seeing how these months on the right side of the screen here, if you've been looking at these numbers and you see here right now, you can see that Jan that we were been talking about, it says 76 implied volatility. If you go to, you know, if we spike and you look at the screen, this still says 76, then you can be fairly confident that they haven't completely cranked volatility to the moon. But certainly all puts are on sale during a spike. You just want to be cognizant of what's going on. And that's probably even more in UVXY than VXX, because UVXY stuff, you know, they're going to widen stuff out. Certainly during a spike, everything's going to get way wide, and it almost seems like there's no way to buy anything, and they make it that way during a spike. Anybody who's been short calls in UVXY knows this to be true, because I was playing the game for a while of selling way out of the money calls in UVXY, and it was kind of the opposite of buying way out of the money puts, in that, you know, it makes intuitive sense that selling the 80 calls in UVXY, right now you can see these March 85 calls are 6 cents bid. It kind of makes intuitive sense. There's no way that this is going to be 60 or 90 in March. Even, you know, 30. There's no way that UVXY is going to be 30, right? It's trading 13 right now. However, the problem is that you sell this 30 call for 50 cents. If we do actually spike up to 30, this call is going to triple, quadruple in value, and you're selling something relatively cheap that can blow up in your face. Yeah, the chances that these March 30 calls are worthless on expiration are huge. However, you sell them, and you're stuck holding a potential powder keg for a long time. Let's see, Mateo. Am I saying it right, Mateo? By the way, I just want to make sure I'm saying your name right. Yeah, that, you know, the trouble with spikes is that a lot of us who trade the VIX all the time, we're left during spikes with no bullets. Like, we've got a position on already. And so when the spike comes, we're like, there's nothing we can do because we don't have that extra money on the sideline. The most beautiful thing is having no money at play and being able to jump in during those situations. The thing is, when you have cash, just no money at play, then there's no way that money's making any money for you. So seldom do people have just tons of cash hanging around to jump in during a spike. But if the situation occurs that you do, you should think about ahead of time what you want to do. And certainly buying puts during a spike is a great idea. Now, I'm sure you noticed on Friday and stuff, if you go in the chat rooms when we were spiking, and it wasn't a big spike on Friday, but it was something, and you go in the chat rooms and everybody's talking about how this is the recession's come and it's all over, and people are putting up all these charts and like, ooh, next stop 2000 in the, SPX next stop 2000, and all these people, and a lot of them are like, big trader names come out and call that this is the top, and it can be hard to pull the trigger there, and stuff can definitely go against you during a spike, but you can do something maybe. Mateo, cool. But you can do something during a spike. And that's the time really to do something. I mean, you can make quick returns in these products if you jump in during a spike. It can be a little scary at times, and last year was a time period where a ton of people got killed. This time last year, December last year, a ton of people got killed. Let's go look back at UVXY at this time last year, because this can easily happen again. People forget very quickly about these things. So this time last year, this is the action we had from May of last year. So May of last year, oh geez, this is not good. Let me fix this, sorry. Much better. May of last year, if you had shorted UVXY, you might have thought you were doing well, and then it just popped in October. It went way back up. And in fact, anytime June, July last year, if you had bought put spreads in UVXY, and maybe you bought long-term stuff and you didn't get out of it, we were in an uptrend for 1, 2, 3 months. We went up month to month in UVXY. And that stuff can certainly happen again, and we don't want to forget about that. Yes, it's been gravy train and this a beautiful chart over the last couple of months, but it will not stay like this forever. And we will have periods like the end of last year where we can have a month or two of up moves. And this is the stuff that I don't want to see you guys get killed in. So be aware that this stuff can happen. It doesn't usually happen, but these moves here, I wouldn't want somebody to, to lose all their money because we get, a couple of these big months of craziness. And this stuff can certainly happen. It can certainly happen again. There's a lot of people who remember this, who are calling for this to happen right now. Now, I don't think it's going to happen right now, but maybe those people are right. We have to plan. As a trader, you have to recognize that you're going to be wrong. And I've certainly recognized that myself. And we all have to recognize that we're going to be wrong at times. And we don't want to have all of our money on the table and be wrong and lose it all. So, yeah, it's been a great time to short this stuff, and it's worked out. It kind of feels like, remember, this is a proxy for the market going up, this stuff going down. It kind of feels like with the SPX and in the general market that a lot of people have missed the rally, and I'd hate for you to have missed the rally and like next week you go and you put all your money in the SPY, or you put all your money shorting UVXY, and all of a sudden the market rolls over. until further notice, it appears like we're continuing to rally, but nobody's sure of what's going to happen, and you can't be sure of what's going to happen. And so, prudence, be careful, my friends. Be careful out there. All right. So, thanks for checking it out. I'm going to leave you here. Please, once again, I apologize if I haven't gotten to all your questions right away. I have a lot of emails coming in and stuff like that. I apologize if I didn't get to your question today. I'd love to hear from you guys about what strategies you're employing right now. I think that I haven't talked much about the bullseye strategy lately. The bullseye strategy is one where you sell at the money calls in UVXY, just a couple, and you let them decay. And it's still valid. The problem is that premium levels are a little low now that UVXY is below $15. It just doesn't feel like there's as much bang for your buck. Selling at the money calls in UVXY. And so I'm on this long-term kick with VXX right now. We'll see if it works out. But I can tell you one thing that's been great for me about buying long-term cheapo puts is that I'm not as flustered when we get a little spike, because I know I've still got a year left on these things, right? And the chance that they're going to take them down so that they're worthless today or tomorrow, even if we spike to 100, I still have a good chance on these things, I feel. And one of the calculations I've been making is, if we look at VXX before we go here, VXX is 15 right now, okay? So if we do a quick calculation with contango, okay, contango right now is over 10%. It was up to 14%, but let's just use 10%. So 10% per month decaying. So if you have a $15 stock, if it's decay 10%, that would be $1.50. So stock goes down in 1 month from 15. So this is kind of like if volatility stayed right here. And it could go lower, it could go higher. The average is maybe it stays right here. Then UVXY would decay by $1.50 in the next month. So that brings us down to $13.50. Okay. So then what's 10% of $13.50? $1.35. So if you subtract $1.35 from $13.50, you get $12.15. So 2 months from now, with volatility the same, UVXY is down to $12.50 and $12.15. And you can see with big contango, this stuff's going to decay pretty quickly. And I guess I said UVXY, I meant VXX. And thus, it seems like $7 is a long way from 15, but when you've got these things decaying over $1 a month, and you've got over 12 months, then you get the point that $7 really is in range. Price is greater than position. All right, so I worked as a market maker for many years in my career, right? Market maker doesn't get to choose his position. We have to do, if Edward wants to buy calls, then I'm selling calls. Especially in illiquid stocks. I was trading many stocks where it was either just me or one or two other people and I were the only people in the world that made markets on these particular issues. So someone wants to buy calls, I'm selling calls. I don't have control over my position. All I have control over is the market and size. So, and you can use exaggerated prices to, and you're going to say, oh, well, that's obvious, Dave, but that is why price is more important than position. So, if you can choose what price if you could choose what price you bought any option in UVXY at, you'd rather have that than being forced to have a certain position on. So, for example, make a mark. What is the value of a particular option? So, look at UVXY. Let's look at February. Let's look at Feb. Close your eyes. Don't even look at it. UVXY is $13. what would you pay for a Feb 13 call in UVXY? If somebody were going to sell you, if UVXY is $13 today, if somebody were to sell you a Feb 13 call for 5 cents, would you buy it? I think you would. So what that illustrates is that everything in the financial market, the whole game of trading is figuring out what something's worth, and you want to buy something that you think you could sell to somebody else for a higher price, or you want to sell something that you think you could buy back lower. Certainly, when you say, and that's when someone says, well, I want to buy put spreads in UVXY, what they really mean is, I want to buy put spreads that at a decent fair value price of what the markets are on the screen right now. That's what they really mean. They're saying they want to buy put spreads, but if it's a $4 put spread and somebody's willing to sell it, like you might be a buyer of put spreads in UVXY, but if it's a $4 put spread and someone's willing to pay you $4.25 for that put spread, how many would you sell them? Well, the most it can be worth is $4. If you can sell them for $4.25, you'd sell them $1 million. You'd sell them until your head caved in, as the expression. Sometimes you get situations on expiration where by buying puts in stock, you can synthetically buy calls for free. So essentially, somebody's actually paying you to own an option. How many of those would you buy? You'd buy them till your head caved in once again. People talk about, well, I'd like to have this position or that. What they mean is they'd like to have those positions at fair value. But if you could buy stuff that was very discounted, I would be a buyer of UVXY calls all day if I could get them very discounted, if I could get them for a lower volatility than I knew the market was trading at. And so that's why price is more important than position in the end. Most of your job as a market maker is being stuck with the opposite of the positions you would like. So if everybody in UVXY wants to buy puts, when there's a spike, everybody in UVXY wants to buy puts. Well, that's fine for me as a market maker. I don't mind selling people puts, just if I can have the price that I want to sell them for, I'll sell you puts all day, even during a huge spike, because if I can sell these puts for a ridiculous price, and we do that with stocks. When there's a earnings coming out or something, we raise volatility to huge, ridiculous prices. If a stock is $30 and I can sell the 30 straddle for $29 and I'm protected all the way down to $1, I'm going to make money. This thing can go from $30 to $1 and I'll still make money. Of course I'm going to sell that. So if I can choose what price I'll trade with you, I'd rather have the ability to choose what price I can trade with you at than the ability to pick what position I have, certainly. Having a position, it doesn't tell you anything. You need to know what prices you got into that position for, what prices you got out of that position for. All right. Best of luck to everybody. I know it's a little scary when we see spikes like that. Friday, it wasn't that big of a spike, and there's a lot of people talking about, coming into a recession. I'd say everybody hold their horses on that. I did see somebody talk about politics higher up in the chat. I don't talk about politics. A lot of people like to, but I think it's, for me as a somebody who's teaching about trading, it's not my thing to talk about politics. I don't want to alienate people. I think it's kind of sort of unprofessional way for me to talk about politics. You'll see a lot of people that have like the name of a company in their Twitter account who are espousing one political view or another. Now, how are you supposed to have customers in life if you're going to push your views on other people? Certainly, whichever party or whichever political view you have, half the country isn't jerks and wrong. And I know a lot of people think that, but it's not true. And I'm going to stop right here because even saying that, I get people mad at me. So I don't like to talk about politics. I hope the best for the country and the world, and for all of you especially. Thank you so much for watching today. Please consider supporting on Patreon. I love the support. Even if you can support just for a month or two, that's awesome. And if you can't support, press the like button, subscribe, tell a friend, anything like that helps out the channel. Love you guys, and I will see you very soon. Until then, hope you make a great deal of money. Have a great weekend, and I'll talk to you soon.